Hello and welcome to the Harwood Report for January 2nd, 2018. Happy New Year, everyone. The Harwood Report, as always, is presented by Trade Academy, and I am Keith Harwood, the host and founder of Trade Academy. Standard disclosures are all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Just remember that everything I do here is just to give you guys a sense of how I look at the markets and is not considered a trade recommendation. Do your own due diligence, consult your financial professional before executing any trade. Options have risk. I'll do my normal stuff here. We're going to look at the equity indices, bonds, gold signals that we're getting, and oil. So with that, let's get straight into it and go through what we're seeing to start this new year. First off, in fear and greed, the levels at 60, there's nothing frightening or exciting about a 60 level in fear and greed, so I'm not going to spend a lot of time on that today. Starting with the S&Ps, Friday we saw that sell-off on the final day of the year, closing near lows and breaking through a couple of prior lows, but nothing crazy here after we've gotten this rally to start the new year. Didn't break through the 20-day moving average. Right now we're back above the 10-day moving average. It looks like SPY is sort of destined to trade to a new high here, which is only about 40 cents away. Not particularly exciting. What might get a little more exciting actually in this is the vol level. So if I look at SPY, vol is about as low as it gets in terms of the 30-day options. Historical volatility has been a little bit low going through the holiday season. We're starting into a new year. New allocations could cause new movement. Today was clearly a bullish run. I need a couple more days of information before I am going to get all bulled up again for this market, especially since my initial price target is really only 30 to 40 cents away. Could happen by the end of the day. What I'm actually going to look at here is this January 19th, 268.5 straddle, about $3.30. Gets a good way to trade if the market does break out and push through 2,700 and go for the next leg higher to 27.0 or 27.50 or something like that in the ES futures. And if not, it gives me something to trade around with volatility, particularly low in the S&Ps. So that's something I'm going to be watching closely today is basically just some long premium strategies with volatility as low as it is and a new year that's causing some potential for new movement. Remember that 7 1/4 vol is really just looking for about a 0.5% move every day. Today we're already up over 0.5%. So we've got some cheap gamma there. And really take advantage of being basically pushed into a long position into a rally or a short position into a sell back off if that occurs. And then just trade around the technical level. So gives me something to trade around. Going into the other sectors, Qs I like a little bit better. And for those of you that have been part of the premium product and everything else, and I think I've been talking about it a little bit in the chat, the big thing that I have here is, or on the video, is free video as well, is that I like looking at semiconductors. Semiconductors had a little bit of a pullback there to end last year, really closer to the beginning of December and the end of November. Hasn't recovered yet. Now we're starting to see some crossing above some moving averages here. The key for me is going to really be still to get back above that 50-day moving average above $100.70. On a move through there, then I think we have to be bulled up on tech because that tells you that money is back allocating into the hottest sector of tech. So if that happens, then the Qs should make a nice run. This is then a sector that could be looking for a push into the 162 range relatively easily if SMH gets that money flow. Volatility is not as cheap in the Qs, but I'll look at some other nuanced calendar plays that I'll put out in the newsletter later today for subscribers. IWM is, it's just chopping sideways right now, back above the moving averages as is the case in basically all of these sectors now. And, I just don't see an exciting trade to the upside. If money flow is going to be in tech, it's not going to let IWM break out. Sure, you can go to 155, but this could be just like the S&Ps where there's a little bit of money flow going into tech, comes out of IWM, or IWM just gets dragged up with a little bit of other buying. This is not the exciting sector to me. Volatility is not so cheap that there's some great play here. I think this is just a grind higher market now after this little bit of a consolidation period. A move above 155, and I can start getting excited again. The real high that I have to watch is 155.41, but until that happens, I'm just going to be watching how we trade against the 10-day moving average, the 20-day moving average, things like that, see how these short where moving averages hold up. And right now, the 20-day moving average is holding up as a decent support level. So move above prior highs or move below the 20-day moving average, I can start looking for something a little more interesting here in a trade. And finally, the Dow Jones, which, as I've said for weeks, it just looks like the S&Ps. So why would I get excited about it? Today it's down a little bit. So maybe something's going to get a little more exciting there. It didn't test the 20-day moving average on Friday like the S&Ps did. It's just basically sitting, though. There's not an exciting trade in the Dow. It is starting to get a little more interesting, though, are rates. We can see that there is a bid to yield today. So TLT is breaking. Interest rates are rising a little bit. It's been a choppy trade in TLT, to say the least. Last week I was saying that I don't know that I can really advocate for a big long position or a big short position for myself. I want to see a break below, relatively, and finally hold below this 200-day moving average to get a bit more bearish on TLT and think that rates are going to really start to push, because that can start pushing me down towards this 119 level, with maybe a little bit of an intermediate stop here around 120, 121. And a move above 128 is what I really need to get a little more excited for the bull side of this. I don't see the bull side playing out, though, unless equities break. So for now, I'm going to stay as a chop trade for me as well, much like IWM. And that's not surprising, because chopping rates tends to lead to chopping financials, and financials are one of the biggest sector, is the biggest sector in small caps. So TLT chop tends to lead towards XLF chop, which tends to lead towards IWM chop. So it's all interrelated, right? If anything, I'd probably lean towards the slightly bearish side of TLT, only under the realization that, yes, we are in a rate hiking cycle, and if the economy is doing well and everybody likes the new year money flow, they're going to push towards long stocks, and that's going to take some money out of bonds, and that's going to give us a little bit of something exciting to play there. But this is more just something to watch against the 200-day moving average for me. The one that's been a little bit surprising to me is dollar yen. So gold, I have felt that it was getting a little bit of money flow off of what's been going on in oil, basically just a general commodity flow. But dollar yen now has broken, and it had a really big break today, actually. It's now testing some sort of key support areas here. The prior low before the turnaround, the 100-day moving average here. So we've got some levels here to trade against. I don't have to get long gold until I start seeing these levels break. So while I would say that my bias has to be towards the long side of precious metals, given where we are relative to some of the short-term moving averages, and the trend looks like it's potentially flipping in dollar yen to maybe something bigger bearish until we breach through the 100-day moving average, and maybe even the 200-day moving average so close by, I'm not necessarily going to look to get too aggressive, but I do want to have my game plan set for what I do if either dollar yen breaks through these moving averages or flips back around and gets back above 113. 113 is key, because that basically puts it back above all key moving averages and puts me bearish in gold and silver and the miners. So start with gold. If it'll load, there we go. Gold has had an incredible run here the last couple of weeks. It's up to 125 for GLD. If we breach those key moving averages in dollar yen, 128 is probably in the cards. And if it fades, I could see us back below 120 fast. So that gives me a trade. Right now, for GLD, vol is still pretty cheap. It's not super cheap the way it has been, but at 9.5%, it's still pretty darn cheap. It was an easier trade with 8.5% vol to go long, just pure long vol without a direction. Now it's a little harder. But if I look back to, say, January 26th, there, it's just because it's the cheapest vol on the board. I can start looking at some potential straddles here, just like I was talking about SPY. Or if I go along the 124.5 straddle at 253, if we get that run up to 128, that's worth $3.50. If we fade back to 120, it's worth $4.50. So there's a lot of money potential to be made by being long that straddle in the short term, and then watching the dollar yen signals for a bigger push into something with a directional bias. And I'm just going to be looking towards buying something under 9.5% volatility if I can, with the direction in my view, because there is a put skew here. The put side I would basically just stay long and out, closer to the money outright put, something in the 30 delta range. If I go into the bearish bias, which is like the January 26, 123 puts here on the bullish side, the call skew is natural. But if this stuff starts looking explosive, then I want to look a little further out of the money, the 20 to 25 delta calls. Even though they're a little bit higher volatility, that's justified because usually into a rally, gold fall gets bid. So I like the way that that's potentially setting up for a bullish play, but right now it's a long volatility play for me. Even though volatility is not as cheap as it's been, it's still relatively cheap given the potential movement we could see off of what's happening in the currency landscape. And just to run through the rest of them to make sure that I'm not seeing something else obvious here, but SLV lagged a little bit in the bounce, but remember this break, this consolidation period, should have probably occurred at a lower price point. Silver was slow to break, and now it hasn't broken through that upper support. So that does still create upper resistance. It still creates resistance up here, but it's not like silver is lagging so greatly that it's a much better opportunity on the long side. And since volatility is pretty fair to gold, I don't necessarily have to look there. I can go to gold where I can get a little bit more leverage and pay lower commissions to execute my trade concept. The miners, on the other hand, actually have shown a little bit more strength than gold, just in terms of recent levels. Remember, gold was up at 128 when the miners were at 25, so that's actually, there's still some room to run there. If this gets really bullish, the miners have a lot of upside, only because the miners underperformed drastically all of last year. They're starting to catch up a little bit, but there was a lot of catch up to do. And finally, GDXJ is the one that has the most catch up to do, obviously. I mean, we can see it was trading in the 40s as early as the beginning of last year, and the high 30s, $38 range in September. Right now, it's up to 35. Yes, it's had a huge run, like I said, but I think that the real opportunity right now is in GLD. And if GLD takes out the upper end, then I'm gonna have to look to the miners for the bullish play. And if GLD starts to break, then these miners could get a pretty quick washout. But volatility has gotten a big bid in miners, and I'll show you what I mean by that. When I look at the gold miner volatility, that's trading now on sort of the upper end of recent history. Again, as I've been saying for months, there's a long way higher to go. But in the short term, I can focus my trade in GLD and know that if something changes where gold just looks like a runaway bull market, gold miners are going to give me a lot of opportunity on the call side, particularly in the juniors, because the juniors have the most leverage. Then we'll finish with oil, and I'll focus you guys first on just oil itself. This has been an incredible run here in the last couple months, really since the beginning of October. Gold oil continues higher and higher and higher. It just shows great support every time we get a dip. XLE, as a result, has been running, but it's not taking out all of the key levels it should. There's a little lag effect because of the fact that it's leveraged to the price of oil. These oil companies are leveraged to them. But note that we're above all these key moving averages, and we're holding above them. The long trend down here through last year, the resistance level was really at the 50-day moving average, and we had a tough time breaking through that. Once we got through that to the upside, it's going to create a lot of support to the downside. We have this 10-day moving average, 20-day moving average is good points to potentially look for re-entry, but it's the 50-day moving average that I would be looking at for a more aggressive positioning. Right now, this could be a little bit more of a sideways move. Note that we are kind of breaking out here. Very easily sets up for a move up to 78. But again, around 69 is the level I would be looking for on the downside to be potentially positioning much more bullishly as long as oil stays firm. OIH, and I've been talking about this being the most leveraged opportunity out there, obviously, is really just testing all these highs and looks prime for a move into the 30s. I got to be honest, I think this has got to be as good of a setup as I can see. That's where I like to be positioning into long options. And part of the reason is XLE, vol's kind of in the fair level. It's not particularly cheap. OIH, vol is kind of in the same fair, slightly cheap level at 25%. I do have some calls on here, and in January at 24.5%. If this thing runs, these 27s at 29 cents are really cheap. I added some on Friday, if this fall stays cheap like this at 24.5%, I'm actually going to look to add more of those today or this week. I'll look to probably take off the 26s because those aren't leveraged anymore. Start looking at the 27s as a way to get new leverage, or even the 27.5s. OIH just has a lot of explosive potential. A move to 30 is hugely beneficial for these kind of options. They go from 29 cents to $3, and obviously the move to $30 may not happen in the next 2.5 weeks, but if something like that happens, that's what gives me this explosive returns profile. So I'm still excited about OIH calls. I'm still looking at ways to play with OIH calls and just managing the position sizing as I get into them. All right, folks, that's it for the free one for today. I'll send out the premium newsletter later. Reminder, if you sign up for it at tradeacademy.co/Harwood Report, you get the first month for free. So it's no risk to you. You get more information on how I'm looking at trading some of those other markets I mentioned, like IWM, the Qs, the miners, silver, XLE. There's some nuanced ways to play those that have really nice return profiles that aren't based upon this expectation of a 10 or 20% type move, like I was talking about in OIH. So there's interesting ways to look at those markets, and I talk about those more in the premium product. So sign up, take a look. It's free. So I hope to see you guys all in the newsletter later today. Contact me, Keith at tradeacademy.co. Call me 312-600-8004, and follow me on Twitter at tradeacademy.co. I'm going to be light on Twitter this week since I am traveling, but I'll get back into posting all my normal watch lists and everything else at the beginning of next week. Have a wonderful start to your new year, folks, and we will continue to talk to you later today, hopefully, for those that sign up for the premium product. And if not, I'll talk to you next week.